Okay, welcome to the second video. And in this video, we're going to complete parts B and C of the question. Now, I've taken the liberty of moving over the information from the appropriation account because we're going to need it in order to do the current account. So let's set up that now. So let's put a divider coming double line down. Okay, so we're going to use a double line to split the left and right side. So this is a debit side and this is a credit side. So the debit side is always on the left and the credit side is always on the right. So here we have the current accounts. Let's merge this. Current accounts. So we're going to have current accounts for Wayne and Tammi. So let's put up two columns, Wayne, Tammi. And the dollar signs. Okay, so the first thing we have to record is what was the opening balance. And in the trial balance, it shows that Wayne is in the credit column. His opening balance is going to be in the credit column. And Tammy's opening balance is going to be in the debit column. So let's put that in. So Wayne had a credit balance of $30,000 in his current account. And Tammi had a debit balance opening of $60,000. Yeah. Let's prepare the space to adjust the numbers automatically. Okay, now what does this credit balance mean? It means that Wayne owes the business money. Sorry, it means that the business owes Wayne money. He's like a creditor. If you look in the trial balance, the line called creditors, which is the list of persons who owe you money, their figure is in the credit column. So in this situation, the business owes Wayne money because Wayne is looked at as a creditor because his current account has a credit balance. Tammi, on the other hand, has a debit balance, just like the debtors. So it means that she owes the business $60,000 at the start of the year. Remember, these are opening balances, and these are the balances at the start of the year. Now let's put in the information that we have. Now, anything that people earn goes on the credit side. That's a big thing I need you to recognize. Anything that the people earn goes on the credit side. And anything else goes on the debit side. Now, the interest on drawings is not money that was earned. These are penalties. So we put the penalties on this side. So Wayne had to pay out $2,000. Tammi paid out $8,000. All right. Now, interest on capital is the first thing that they earned as partners. They earn that money. So it's taken out, it's less from the profits and transferred here. So Wayne earned 10,000. Tammi earned 15,000. Now Wayne also earned some extra money as salary. Tammi didn't. So we're going to pick up Wayne's salary of 20,000. And Tammi didn't earn anything. And the last thing we pick up is the share of profits. And Wayne earned 18,968 and Tammi earned 28,452. So all the earnings that everything they earned, which was calculated in the appropriation account, is now picked up in the current account. Now the last thing we need to include to wrap up this is the drawings itself. So the drawings also has to pass through the current account. And let's see now. Wayne took out 20,000 and Tammi took out 80,000. So we're going to balance off the accounts to see at the end of the day who owes the business, meaning that they're going to have a credit balance, a debit balance. Who owes the business means that they're going to end up with a debit balance, and who the business owes, which means that they're going to end up with a credit balance. Okay, let's look at it. So let's use this as an opportunity to remind you how to balance an account. So let's look at Wayne's figures first. This is Wayne's debit side, and this is Wayne's credit side. And when I look at Wayne's account, the credit side looks bigger. So it means then that we can add up this figure. Let me add it up here. So the first step in balancing your account is to total both sides, which is what I'm doing now. So I'm adding up the debit side and the credit side. The debit side is smaller for Wayne, $22,000, and the credit side is bigger for Wayne, $78,968. That's step one. Total both sides. Step two. Find the difference between the two numbers and put that difference on the smaller side. So I'm going to put the difference here. Difference meaning that I'm going to subtract the 22 from the 78. So the difference between the two figures is $59,968. So step two was to find the difference between both sides, which comes to $56,968, and put the difference on the smaller side, which in Wayne's case happens to be the debit side. So this is going to be his balance carried down. So Wayne's balance carried down is on the debit side. Let's look at Tammi. Tammi's debit side came to 88. No, so that doesn't look right. Tammi's debit side comes to 148,000. Let's do this again. Tammy's debit side comes to 148,000. Tammy's credit side comes to 43,000. So her smaller side is her credit side. So that was step one, identifying the totals for the debit and credit side. Step two is finding the difference and putting it on the smaller side. So Tammy's smaller side is the credit side. Let's pick up the difference now. 148,000 minus 43,452. So this is going to be Tammy's balance carried down. So let's total up everything now. So step 2 is just to total up the accounts. So let's do that now. Put in our totals. I'm copying it over. So now that we have balanced off Wayne's 2 columns, the debit and credit column, our totals have the same figure. Let's check for Tammi's one. Her total is, on the debit side is 148,000. And her total on the credit side is 148. All right, so we've finished the current account. All we have to do now is bring the balances down. So Tammi's credit balance carried down. It's going to be brought down on the debit side. That's the last step. You cross over the balances. So Tammi's credit balance now becomes her debit balance, her new balance in her current account. Remember, previously it was 60. At the end of the year, it's now 104,548. For Wayne, his carry down balance was on the debit side. So his brought down balance is going to be on the credit side. So Wayne started the year with a credit balance of 30,000, and he ends the year with another credit balance of 56,968. So these are the new figures that will go in the statement of profit, statement of financial position. His current account balance would be a credit of 56,968, and Tammi's current account balance would be a debit balance of 104,548. Now let us go and work now on the final document. This was part B. This is part B. So now we're going to work on part C. And part C is a statement of financial position. Oops. All right, so again, we need to label the document. So I'm putting in Wayne and Tammi. And the name of the business is the Ivy Arrow. ARROW. And we're going to put in the name of the document. It's a statement of financial position. And if you remember from our meeting yesterday, it only has 3 sets of things in there: assets, liabilities, and equity. So let's put in we have to put in the date. So this title is very important. You can lose marks in the exam if you do not title your document properly. All right, so the first category we're going to be putting up is our non-current assets. And there are 3 labels we're going to use. We're going to pick up the cost. We're going to pick up the provision for depreciation. We're going to pick up the net book value. All right, so these headings here, the cost, the provision for depreciation, and the net book value, only relate to the non-current assets. Let's quickly list them. We have land and building. we have motor vehicle, we have machinery and equipment, now we have the costs. Remember now the cost figures came from the debit column. Let's pick those up quickly. 20. For the motor vehicle it was 290, and for the machinery and equipment it was 132. So the first set of data we picked up for this section is the cost of the assets, and these are found in the trial balance in the debit column. Okay. Now the provision for depreciation, the figures we saw in the trial balance were for the old years, and we need to add that to the calculations we made for this year. So the provision for depreciation for the building was originally $45,000. So, I didn't bring over the figures. It was 10%. Okay, let me just do a quick calculation here. It was 10% of the net book value of $220,000 minus the provision figure of $45,000. Okay, let's try this. It's 45,000 plus 10%. 10% of 220,000 minus 45,000. Okay. All right, let's I'm gonna have to look for the figures. All right, the point is that these figures that I'm putting in here are not correct because we have to add in the figures that we calculated for this year. So I'm going to have to come back and change it. Now here's the thing. The final column, which is the net book value, is found by taking the cost and subtracting it from the new, which we haven't worked out yet, the new provision for depreciation. So when you come back, we're going to put in the figures we had calculated so that this column can be correct. All right, so this is the first section. The first section of the statement of financial position, and we're simply calculating the total net book value for the non-current assets. The next section is the current assets. And the current assets are your closing stock, which was found in the notes, and that closing stock is 64,000. Then we have our debtors, the people who owe the business money, but then we had worked out a provision for bad debt on it. Debtors figure was 54,350, and we had to subtract from that the new provision for bad debt, which was 10% of this figure. So what we're saying is that 10% of this figure may not be collected. So just a correction here. So it's 10% of the figure. So we're going to take out this amount of 5,435, because what it is essentially saying is that, hey, we think that this amount may not be collected. So the real collectible amount for debtors is the difference, which is $48,915. Then we're going to look at our bank account. Let us see, it's an overdraft, so we're not going to put it here. We have cash, and the figure for cash is 18,200. All right. Now, in this section also, we put prepaid expenses. We have no prepaid expenses in this example. We have accrued income, and we have no such examples in this question. But if we had them, this is where you would place them. So it means then that the total amount of current assets for the year is $131,115. We can now wrap up the top part of our calculation. So the sum of the assets so far, we would find the figure here. But remember now, this figure is not correct because we have not added to these the calculations for this year. But we're moving along. The next section we're going to put in is our equity and liabilities. So our equity, that's the first section we're going to do, the equity section. We start with the opening capital, and this figure came from the trial balance, which is the capitals for the partners. So Tammi and Wayne, we're going to pick up their capital figures. So Wayne had $100,000 and Tammi was $150,000. So part of their equity is a capital, and that comes to $250,000. So that is how you display the capital account for the partnership. But we also have the current account to display for Wayne and Tammi. So Wayne's account, now bear in mind now, capital accounts, we form the capital accounts in the credit column and show them as positive figures. But if any of the current accounts have a debit value, a debit balance value, we have to put a bracket around it. So when I scroll up, Tammi's figure 105,548 is a debit figure. So we're going to have to show that with a bracket in the statement of financial position. So let me pick that up. hers is a debit balance, right? And Wayne's is a credit balance. So his figure will show up as a positive in this document. So combined, we have a negative figure overall because of Tammi. So that's the equity. Now let's look at the liabilities. We have non-current, and we have only one of them, and it's the loan with the interest rate set at 10%, and the loan figure is $270,000. And then the final section is our current liabilities. Now I must point out here that different teachers teach different layouts. So this might not be the one that you were taught, but you can always adjust, because the main thing that you need to learn is what heading to place them under. That's what is critical. So what are the current liabilities? The first one is our creditors. That is the people to whom money is owed, and that was 61,315. So I'm going to list them in this column F. Then we had our bank overdraft, because the bank figure was in the credit column and not in the debit column. And the bank figure was 79,300. We had our unpaid interest of 12,000, remember? This is where you put it. We have our accrued expenses. That is expenses which were unpaid at the end of the year, but you had incurred them. Let me list it separately for you so you can track it. So we had insurance, which was owing, wages and salaries, that was owing, telephone, that was owing. So all of these, you're going to just lump them and put them as one figure. Insurance was 15, wages and salaries was 2,000, telephone was 1,000. So the combined figure for accrued expenses, meaning monies that are still owing, okay, on these expenses, came to $4,500. And the last figure that I'm going to include is the prepaid income that falls here, meaning that you get money for work you have not done yet. So that's a liability to you because you have to give them the service. And the prepaid income was the commissions. That's the only one we had. And that figure was $3,000. So the total current liability comes to $160,000. So this wraps up the credit part, the bottom part of this statement of profit or loss. So let's add up the equity and liabilities section, starting with the capitals, the current account balances, the non-current liabilities, the current liabilities. $632,535. Now, if we had entered our depreciation figures, then this too would have been saying a different figure. In fact, it would be saying this 632,535. So let's go. I'm going to go and pick up the depreciation figures from the other worksheet. So let me quickly jump over and pick that up. So for the land and building, the figure was 17,500. That's going to be added on. For the machinery and equipment, it was 11,880. For the motor vehicle, it was 29,000. Right, so I'm going to now go back to my worksheet and adjust these old provision figures to reflect the new data. So we're adding on to this 17,500. We're adding on to this from motor vehicle 29,000, and we're adding on to the machinery and equipment 11,850, 880. All right, so our assets come to 632,535, and our equity liability come to 632,535. Okay, good. So we're balanced now. Let me just check. We're taking up this figure and subtracting it from this figure. Just to double check. Right. So notice 0. Good. So we have completed the partner's current accounts, and we've just now wrapped up the statement of financial position. Okay, so you're good. So that marks the end of the question. There's a part D, which is a discussion section, and it is asking to explain the use and relationship between the Partnership Act and the Partnership Deed. Now, the Partnership Act in any country represents some established rules that are going to govern how the partnership is run. Now, a partnership deed will add to that information to ensure that there are no questions as to how the partnership will operate. So the Partnership Act governs all partnerships. But the partnership deed is now going to be specific to each individual partnership. So they will have to work, the act and the deed have to work together to support the business. So you can do further research on that. So you can add more to the answer for part D. All right, that is it. I will catch up with you another time. Take care.